Hey guys, my name is Jeff McCarthy with Simply Better Home Loans and Bingham Realty, and today I just want to go over a few things of the do's and don'ts of home buying. This also can be applied to refinancing, but it's just some things that you can do and some things you can't do during the process. So first off, let's start with the do's. We are going to do three things. There are more things we can do, but these are the three things that are most important. So the number one thing is do continue to pay your mortgage or rent on time. The lender will check this. They will either do something called a VOM, which is a verification of mortgage, or a VOR, which is a verification of rent. So they want to make sure that you're not 30 days or later on a payment. So during a refinance or during a home purchase, just remember to constantly pay your mortgage and, for that matter, all of your bills on time. Do you maintain good payment history on all accounts? That basically just applies from the previous one to now. The lender will pull their own credit report. So they will look at all the trade lines, all the accounts that are open up on your credit report, and then they want to make sure that you have on-time payments and that you're paying them the amount of money that you're supposed to. Now, if you're late here and there, that's not a big deal. 1 30-day late is not going to kill a deal. It may affect your interest rate. So having what we call a 0 times 30, which means there's no 30-day lates, really will help your interest rate and help process your loan a little bit faster. And then the last thing is just let us know if there's anything that financially changes. Sometimes you might be a co-signer on a note. Sometimes you might close an account or something like that, or make a last payment on an account. Just let us know so we can inform the lender and let them know that they might see something that may not have been seen when you previously submitted the loan. So really, just keeping an open line of communication throughout the whole process just lets the process really happen a lot quicker and smoother. So we'll go through the don'ts real quick. There's more don'ts than do's. There's actually more than these 4, but we'll start with these 4. These tend to be the most important ones during what we call the escrow or the transaction process. So the number one thing is do not finance anything during the transaction. This is very important. I have actually had deals that had to be canceled or really basically terminated because towards the end of the escrow period, they went to go buy outdoor furniture or new furniture for the home or anything like that, and they financed it. And the lender will find out. In fact, there is a declaration. You declare that you will not take any financing during the home loan process. So they will find out. And then they will have to add that to your debt to income ratio. And a lot of times that will tend to push you over the limit. So the number one thing is don't finance anything during the transaction. Once you sign the papers and it's funded, have at it, do whatever you want. So do not pull credit during the loan process. So there's 2 things. One, you're going to have the process before the loan process, which is when you're shopping for a loan. During that time, you have 45 days from the time that the original mortgage person or loan officer pulls your credit until subsequent credit pulls get dinged on your credit. So you have 45 days to have a lot of people go ahead and pull your credit, but it's only going to ding your credit just once. So my advice is do that. Have many people pull your credit. Try to find the best program. Try to find anything that's only going to be dinging on your credit once as a hard inquiry. Then once you're in the loan process, just make sure not to have anyone else pull your credit, because if they see more credit inquiries, the lender might get suspicious and might have to do a little more digging. So do not close any accounts during the loan process. Some of this may be inevitable, as if you're making a last payment or something like that, and the lender will know that. But a lot of times closing an account actually has a worse effect on your credit report initially than most people think. Most people think, hey, I'm closing this account out, I'm out of debt, that should help my credit report, my FICO score. But actually, that's reducing your trade lines, and it can have a negative effect initially on your credit report. So just try not to close anything during the transaction. The last thing is don't quit your job or change industries or move from salary to commission during the loan process. This is usually a no-brainer, but it's always good to say that we get all the income documentations from your current job, and we are basing the loan terms on those current employment. And any changes in that can really have a detrimental effect on the loan process. So a couple of do's and don'ts for you guys to look at. If you have any more questions, reach out to me, Jeff. Tiffany or Will or anyone at Bingham Realty, and we'll be more than happy to answer your questions. All right? Take care, guys, and happy house hunting.